So now what is this predictive trading system? Let's kind of understand this a little bit more detail, right? So now markets can either be bullish or bearish, right? We know that market either goes up or comes down. Now if you have to kind of there is one kind of trading system which is trend following, where we typically do not predict. We kind of design entry and exit based on some kind of understanding what we have, and do extensive backtesting, and then jump onto that system and remain in that system perpetually for 12 months. That is trend following, where there is no prediction. Now here in these systems, what you're going to learn here, we have to kind of predict. When I say predict, we're not going to kind of randomly predict. What we're going to do is we are going to look at certain signals which the price gives, which the market gives. Basis that signal, we will either go long or short. Now why do we know that this signal means this is what it is? Again, that is because of the past observation of the price movements. When the price movement happens in certain way, we look at what are the changes it does, what are the pattern shifts it happens, and basis that over many years of study of stock market, it has been well established and proven that if certain kind of situation happens, after that situation price may either go up or come down, and that's what we're going to capitalize. And we will look for those situations or those conditions to prevail. If those conditions prevail, either we go long or short, and then we anticipate, in an anticipation that the price may go in the direction which we have chosen, which we have rather predicted. So the prediction is not random again. The prediction is if situations A, B, C, D happens, or if conditions A, B, C, D happens, then there is a possibility that market may either go long or go short, or go bullish or go bearish, or go long, go up or go down. So now when we have studied that, if certain conditions happen, the market may kind of go up. So from here, after all the conditions have taken place, only after all the conditions have taken place, I get on to my trade and hold my trade until I reach a certain place, certain direction, certain distance, and then exit my trade. So this is predictive trades, where we are kind of slightly ahead of the market in our thought. When I say ahead of the market, where we have made a judgment call based on certain conditions that the market will go in that direction, so I hold my position in that direction. So that is called as predictive. So you are using the probability. So there is an element of probability. Now, whenever those conditions happen, will it always and always work? No, absolutely not. But the probability is higher. So we are going to use that probability theory and the previous experience what we have seen, and then kind of trade. Now once you kind of get into these kinds of trade, you have to consistently do these kinds of trade for a sustainable period of time. When I say sustainable period of time, it's not like today you felt like you saw that opportunity, you took a trade, and then that trade was a loss, as an example, right? And then next day or after 1 week, again you come back and again you take, again that is a loss. So 2 times you took, you say, oh, this system does not work. So it is not like that. How to kind of stick on to these kinds of system is that you will look at these systems, study this, understand this, choose which suits you, both based on the time frames what we trade and how the systems are placed. See what resonates, and once you choose in that system, you have to take at least be in that. If it is a shorter time period, less than a day's time period, like in minutes, you have to take at least 100 trades. And other time frames, you got to be in that system for at least 6 months. Consistently taking all the trades, or as many trades comes up on a consistent frequency and consistent basis. It's not like one day you do, after that 3 days or 5 days, 10 days you don't do, and suddenly come back if it's intraday. Like if it is swing, 1 week you do, then 5 weeks you don't do it, and then come back. No, it cannot be like that. You got to be in that system and in that way of style of trading on a consistent basis, because it's a business. So all businesses have to be done on a consistent basis. It's not that you open up your shop one day and after that you close it for 10 days. No, it cannot, right? You got to open up your shop at every juncture when it has to be opened up. Same thing here also in predictive trade. So you got to consistently do it. Of course, you can choose that you open up your shop only 2 days a week, but every week those 2 days you have to, must and should open. It cannot happen that 1 week you open 2 days, second week you open 1 day, third week you open 5 days, and again next week you open only 1 day, and then next week you close it. It cannot be random. It has to be systematic, and there has to be consistency even in your approach. So that is called as predictive trades in general. Now let us kind of understand so far and go deeper into kind of each of those styles of trading, and once again make a revisit to this. We already kind of visited that in the previous model, but let's kind of redo that once again in the next video. See you in the next video. Bye bye.